It was a strange week last week for Peloton. The company announced their fiscal third quarter 2024 results. That's the calendar first quarter of the year. But they also announced that they were going to replace their CEO, who has been there for a couple of years, is a huge part of the turnaround plan, and has another layoff coming. So more cost reductions. And there's, I think, a lot of different ways to think about the changes in the business. Some of the areas that I hoped were going to grow in 2024 really haven't grown, but some of the areas that are a little bit more legacy in the business have been much more sticky. So this is a stock that I own. I don't have a big position in it, but it was one of those stocks that I thought had 10x potential, but it had 10x or 0x potential as it goes in asymmetric investing. So I'm going to dig through the results, the market's reaction, which was actually very positive. Shares were up about 10% on Friday. And then go through how to think about this company long term, because this is another transition point for Peloton. We're at a much better position than we were 2 years ago, let's say, but it's not all good for Peloton. So I want to kind of balance the two of those things out. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's get to the CEO announcement first, because that's, I think, was the most surprising to most of us. And this is the announcement. CEO Barry McCarthy is stepping down as CEO, president, and board director. Peloton board members Karen Boone and Chris Bruzzo will serve as interim co-CEOs. Jay Hoag becomes the chairperson of the board, and there is now a CEO search underway. They talked a lot about this on the conference call, but I thought it was pretty striking that McCarthy was not part of the conference call. So they had very positive things to say about McCarthy, but very clearly wanted to take the company in a different direction. And so this felt extremely abrupt. I don't think there's really any other way to put it. McCarthy was, I think, pretty clearly pushed out. The other thing is that these layoffs were announced at the same time. $200 million in cost reductions by the end of fiscal 2025. Remember, that's going to be 18 months from now. And remember, that's going to be 5 quarters from now, not on a calendar year from a fiscal perspective. And they said a lot of these costs would be implemented right away. Impacts roughly 15% of the workforce, or 400 Peloton team members. They're going to continue reducing their retail footprint and reimagine the international go-to-market strategy. This was, again, another big part of the conference call, was rethinking how the company is going to market internationally. They've had a lot of success in the US, not so much leveraging that in some international markets. So those are the major news items and kind of overshadowed everything else in the results. But I want to go through some of the specific results and where there was some really, really positive news and where there was some, I thought, really bad news. As I always like to do, I want to start here with some of their operating metrics. They read this left to right. The number of members, 6.6 million. The first thing that they always go through is what's called the connected fitness subscriptions. This is people who have a piece of equipment, so a bike or a treadmill. That was up 2% from a year ago to 3,056,000. But here's the number that they're now disclosing that I think is really telling. Monthly churn is 1.2%. Just to put that into perspective, Netflix monthly churn is about 2%. Disney Plus monthly churn is 4 or 5%. So this is an extremely low churn number. That means that your lifetime value of a customer who actually buys a piece of equipment is extremely high, because they're more likely than not going to be a customer for 5 to 10 years. So this is a very, very strong number. It tells you that this business is very sticky, and this is going to ultimately drive the subscription business, which is what you want to see for Peloton. But here's where I think it gets much worse. The app business is not doing well at all. Ending paid app subscriptions, 674,000. That was down 21% from a year ago. This is one of the reasons that I think this could be an asymmetric stock, is because you film these classes once, you build the infrastructure once, and then you can sell it millions and millions of times, especially when you're connecting to an app. There's no friction in buying a purchase like this on an app. You just sign up for your monthly subscription. You don't even have to get a piece of hardware. And they got a lot of great content now for that. But clearly this is not getting a lot of adoption. And you can see that in the monthly churn numbers. I thought this 7.2% number last quarter, which they started disclosing, was going to come. Now we're at 9.2%. So that's clearly not the case. This is something that I would expect over the next few months, the next few quarters. They're going to reimagine a little bit. What they talked about is that they've seen more people signing up for the high end of the app than they expected, and not as many people on the low end, or not as many people trying free subscriptions, and then even converting to that lower price tier. So maybe they kind of rethink things a little bit. Maybe there's not as much of a free tier. Maybe it just goes free to that $25 mark, and then you also have the $44 mark, which is what the connected fitness number is. I don't know exactly where they're going to go, but this is clearly something that they have tested over the last 6 to 12 months and just hasn't worked the way that they hoped. And that's one of the reasons that results were so disappointing. I think that's one of the reasons McCarthy's probably out as CEO. So keep an eye on that in the future. This was very disappointing. The connected fitness side, very positive. And they talked a lot about how they're going to actually lean into the treadmill more. There's about double the market size for treadmill users as there is for bike users. And so if you get a very sticky business, you can increase this potentially a significant amount by adding more people with treadmills. That could be a great addition to the business and something they haven't quite focused on yet. So look for that to be the focus on that kind of super premium side. And then on the app side, a lot of uncertainty. I still think that's where the financial potential is, but clearly we aren't seeing that in the numbers. Connected fitness product revenue, $279.9 million. That was down 12% year over year. But the good news is it's profitable, at least a little bit profitable, 4.2% gross profit margin. You want this to be at even just a little bit profitable. That's really all you want out of Peloton. What you want to see growth in is subscription revenue and profits. Revenue is up 4%. Profitability is still very strong with a subscription gross margin of 68.1%. So love what we're seeing from the subscription business. And this number is really the big one to see growing over time. And this, if the subscription gross profit is higher than your operating expenses, which obviously it isn't right here, then that's how you get to a profitable future. So that's one of the reasons that they're trying to lower those operating expenses and at least do whatever they can do to increase those subscription expenses. But you lower this by another $200 million, suddenly you're much closer to being profitable on an ongoing basis. This was the other big thing that the market was focused on. Free cash flow was positive, $8.6 million in positive free cash flow. Why is that important? As we stand right now, Peloton has $991.4 million in convertible senior notes and $692 million in a term loan. So there's about $1.7 billion worth of debt. If you're not positive free cash flow, you can't pay off that debt. And so Peloton needs to get to profitability and positive free cash flow in the near future. There is $794 million worth of cash. So the company's not in a terrible financial position, but this is definitely something they're going to have to work through over the next few years just to give some more flexibility to the business. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So where does Peloton go from here? Well, I think what we can take out of the conference call and this earnings report is that they're going to continue to focus on cost reductions, try to get some operating leverage in the existing business, and really focus on that premium side, those connected fitness subscribers who have made the commitment to buy a bike or a treadmill, some sort of a piece of equipment like that. But it doesn't seem like their app service is really all that successful. And I think that's where the ultimate major upside was for Peloton. So can this be a profitable business just focusing on that kind of more niche market? It's very possible that it can be, probably not a ton of upside, because having 3 million subscribers to that kind of a service, you can maybe double that over the next decade or so, but I don't think there's going to be tens of millions of subscribers with bikes in their homes or treadmills in their homes. That's just not the kind of business that Peloton is in, and I don't think there's that kind of market. So it changes the upside. Now, with that said, the company is on much more solid footing today, being even slightly free cash flow positive, and like we talked about, having some cost reductions coming down the line. So it's very possible that they can have a couple $100 million in positive free cash flow. That gives you the ability to pay down debt or at least refinance debt at more attractive rates. And Peloton's market cap is only $1.26 billion as I'm recording right now. So potential upside there if they get through the next couple of years and actually figure out a strategy that works, that maybe isn't quite as moonshot as the app strategy. But this leaves me kind of uncertain as an investor. And what I'm going to do, and what I have found successful in the past in these kind of situations, is just wait and see what happens. And the reason I'm going to do that and not sell the stock, not double down on the stock, is just because I don't think we know for certain whether there is some sort of turnaround or what that looks like, or whether the company's heading down the wrong path. I do think they have a great product. They have obviously very, very loyal customers. That churn rate is the one thing that should keep any investor from selling the stock, because they obviously have a very, very loyal fan base of users. The question is, how much can they grow that? And I just don't think we have the answer to that right now. So I'm going to wait and see at least a few more quarters, see if they come out with some sort of app strategy that's going to work, or some sort of treadmill strategy that's going to actually get some sort of adoption. There's always things coming down the pipeline, like B2B sales or subscriptions that can be included with healthcare plans or with major businesses. I think there's a lot of potential upside there, but we just haven't seen it yet. We haven't seen that kind of momentum that I would like to have seen. So I'm going to stand pat and do what I think a lot of investors should do in many more situations, which is absolutely nothing. I'm not going to add to my Peloton position. I'm not going to sell my Peloton position. I'm just going to wait and see what happens over the next few quarters. But what do you think? Did you like the quarter from Peloton or the direction the company is heading? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you next time.